Hello guys, we were discussing amalgamation in the previous video. We've discussed introduction to amalgamation in the previous video, and in this video, as I gave the little introduction in the last one, we are going to discuss purchase consideration. And in the next video, we'll be learning the journal entries for amalgamation. Come on, let's get started with introduction is done, purchase consideration. The question is, what is purchase consideration? Whatever I buy, I bought this mouse. To buy this mouse, what I paid is consideration. I bought this water bottle. When I bought this water bottle, what I paid is consideration. So consideration is something in return against a item that I acquired. Whenever I buy something, what I pay is consideration. Same is happening here also. Purchase consideration is what I pay when I acquire their business. Me as a company being transferee company, the one who is calling. In Kannada, for receiving we say is kolud. So the company which is calling is transferee company. The one is which is giving is a transferor company. Me, transferee company, when I acquire the business of transferor company, I am receiving assets, liabilities, and the entire business of transferor company. For receiving assets, liabilities, and the business of the transferor company, I have to compensate them and then pay them money. So such money in any form that I pay to the transferor company is purchase consideration. So purchase consideration is what we pay to transferor company. But the people involved in transferor company can be categorized into three broad classifications. See, in the transferor company, there are three broad categories of people. Who are they? Number one, equity shareholders. Number two, preference shareholders. Number three, debenture holders. Now, my question is, I would definitely not be giving only shares or only debentures to transferor company. I can give my consideration in any form. Consideration is something in return, not specifically this particular item. It need not be cash. It need not be check. It need not be equity share. It need not be preference share only. It need not be debenture only. It can be a combination of all of this. So I have given to the transferor company equity shares in transferee company, preference shares in transferee company, debentures in transferee company, cash as well as check. So when I've given purchase consideration in all of these five forms to transferor company will give some of it to equity shareholders, some of it to preference shareholders, and some of it to debenture holders. My question is, when equity shares, preference shares, debentures in transferee company and check as well as cash is given to equity shareholders, equity shares, preference shares, debentures in transferee company, and check and cash is given to preference shareholders. And again, equity shares, preference shares, and debentures in transferee company, and check and cash is given to debenture holders. What is PC? What is PC? Is everything given to every other person PC, or is it the things given to only equity shareholders PC, or is it the thing given to equity shareholders and preference shareholders that is PC, or is it like what we give that matters, like only equity shares given, whether it is to equity shareholders, whether it is to preference shareholders, or whether it is to debenture holders? Is that PC? That is the question. A lot of them don't take a pause here and then understand this concept, go down to do even problems on amalgamation and also clear CA intern, but they don't really have the clarity on what is purchase consideration. Life is not always a 14 marks question, my friend. You might survive the examination, but in the life you might get stuck at point. So let's have some conceptual clarity on what is PC. To summarize the question that I'm asking you, it's very simple. My question is it what we give that matters, or is it to whom we give that matters? Let me rephrase my question. Let me repeat my question. Is it what we give that matters, or is it to whom we give that matters? Is it like what is given to these people is PC, irrespective of what you give? Or is it like, no, to whom we give doesn't matter. What are we giving? If we are giving shares, it is PC. If we are giving debentures, it is not PC. Is it that way? I want you to think, take a pause, take a deep breath, think, write down the answer on the paper, and then listen to my explanation. Did you write? I hope you did. Now let me tell you. What matters is to whom we give and not what we give. What does matter? Okay, what matters is to whom are we giving and not about what are we giving. So if you are giving it to equity shareholders, and giving it to preference shareholders of transferor company, the small company. No matter what you give them, whether you give them equity shares, you give them preference shares, you give them debentures, you give them check, you give them cash, it is still PC. It is still PC. But to debenture holders of transferor company, no matter what you give, it is never PC. So it's about to whom are you giving, not about what you are giving. Even if you give debentures to equity shareholders of transferor company, it is PC. But if you give equity shares to debenture holders of transferor company, not PC. Why? Hey, you acquired their business. You acquired their assets and liabilities. So what you give is PC. Right? You are acquiring their business. Transferors, assets, liabilities, and business is what is acquired by transferee. So whatever purchase consideration is given by transferee is to transferor company's owners. The one who owns those assets. One who is liable to pay those liabilities. Are debenture holders owners of assets? No, incorrect. Assets, liabilities, entire thing. The ownership is with shareholders. Now don't bring this concept of equity shareholders are the true owners. What? Preference shareholders are false owners. Huh? No, preference shareholders are also owners. Preference shareholders are owners with preferential rights when it comes to distribution of dividend and repayment of capital. When everyone is standing in queue to collect dividend and to collect money on capital, that is redemption of shares or buyback. Buyback is not possible with regard to preference shares. We call it redemption. Redemption is not possible with regard to equity. When the capital is repaid or when the dividend is paid and all the shareholders are standing in queue, some people stand ahead in the queue. That people who stand ahead in the queue are preference shareholders. So preference shareholders are also shareholders. Now don't bring in the true owners, false owners. No. Owners. Owners of the company are equity shareholders and preference shareholders. To this equity and preference shareholders, whatever we give is PC. Whatever we give in any form, PC. Whether it is equity shares, preference shares, debentures, check or cash. So the thumb line or conclusion is very simple. What really matters is to whom we give. What really matters is to whom we give and not about what we give. You get that? So equity shares, preference shares, debentures, cash, check given to the shareholders of the transferor company is what we call as purchase consideration. I hope you understood. Any form of money in any form given to debenture holders is not part of PC. I hope you understood. I'll show the screen to you for a brief 10 seconds. If you want, you can pause and then take a screenshot or note it down. Or like I mentioned in the past, if you want the PDF copy of this, you can drop in a message to me. You can find me. My name is CA Rajavardhan. Or you can also call me accounts man, like people from the student community usually call. Search me, ping me, take this PDF if it can help you in exam preparation. Yes, I hope you have. Come on, let's get going. Now we'll talk about computation of purchase consideration. How to compute purchase consideration? There are several forms or several methods of computing purchase consideration. The first one is called as lump sum method, or I'll also call this as student's favorite method. Lump sum method, what happens is, like you pack all the money into one bag, no? They will tell this much is PC. The question all by itself will say PC is 14 lakh, PC is 25 lakh, PC is 30 lakh. They will tell it is computed, agreed by transferor, transferee, and if you see examination perspective, this lump sum amount is mentioned and then shared to us by way of a clear mention in the question. That is lump sum method. So under this method, transferee company agrees to pay a lump sum or fixed amount to shareholders of transferor company. Need not be in cash. Need not be in cash, but lump sum amount is told to us, and this money is to be paid by transferee company to transferor company. Got that, guys? What do we have next? What do we have after this is second method. This is called as payment method. What is it called? Payment method. Under payment method, they will not tell a lump sum amount, but they'll tell various forms in which we are paying. They'll tell these many equity shares are given at this rate. These many preference shares are given at this rate. These many debentures are issued at this much premium. This much of cash is given. These many equity shares are given in transferee company for these many equity shares which are there in transferor company. So they'll give that ratio. For 3 shares in transferor, you will get 2 shares in transferee. For every one share in transferor, you get two debentures in transferee. For every one share in transferor, you get 10 rupees cash. So they'll give various modes and forms of payment. So we will take these modes and forms of payment which is given in English, compare it with the transferor's balance sheet and then multiply or exchange ratio. You basically compute. Total them up, that is nothing but lump sum amount as PC. You get that? So if they give the total, it is lump sum method. If they give the breakup, it is payment method. Sometimes it can so happen that they'll give payments, you would have to find total. Sometimes they'll give total, you might have to actually find breakup of that payments. You know why? When we go down to discuss accounting entries, which we're going to do in the next video, you would need the split. If you don't know the split, how can you pass the accounting entry? So lump sum method and payment method are like brother and sister, they go together. You get that? So payment method, various forms and modes will be told to us and we'll find the total piece. Have a look. Under this method, details of payment made by the transferee company to equity and preference shareholders of the transferor company is provided, and we basically compute the total PC. Let's now go to the third method. Third method is called as NATO method. Sir, NATO we read in social science and tensor. No. This is different. I call it NATO. The expansion or the abbreviated form is net assets taken over method. What is it? Net assets taken over method. So there we go. We have the next method, net assets taken over method or net assets method. NAM or NATO. What is this? Transferor company's assets, liabilities and business is taken over by transferee. When we're taking the asset, we keep one paper, we keep one pen. A land and building. Okay, a land and building, I'll take it 15 lakh. Next, what do you have? Plant and machinery. Okay, 8 lakh. Motor vehicle. See, all Gujri type it is 1 lakh. Then what do you have? Plant, furniture. Okay, furniture. 50,000. So like this, they'll note down the prices, agree the prices at which the transferee and transferor are willing to exchange these. Transferor also will have say, transferee will say furniture will rate 50, then transfer will say hey, 50 is very less, yeah, I can sell it on OLX for 60,000. Transferee will say 55, transferor will be like okay 55. So they agree upon the value like this. So this agreed value of assets will be written total. That is not net assets, that is total assets at agreed value. Then liabilities of the transferor company will also be written at agreed value, less creditors, bills payable, bank or everything they'll deduct. Then what we arrive at is net assets, meaning net assets at agreed value taken over by transferee from transferor. In this net assets computation, certain assets can be left out. Now transferee doesn't want to take that land and building, or transferee doesn't want to take that plant and machinery, or doesn't want to take that furniture, or transferor is not willing to sell that land and building. They are selling the business, but they'll retain that land. Is that possible? Very much possible. Sir, but doesn't that make it amalgamation in the nature of purchase? Yes. If you remember 5 conditions that we discussed in the last video, if you have forgotten, you can go back to part 1 and then see that all the assets and liabilities of transferor should be transferred to transferee. If any asset is not transferred by transferor or not taken over by transferee, it becomes amalgamation in the nature of purchase. That is okay. But all the assets taken over by transferee company at the agreed value less liabilities taken over by transferee company at the agreed value, if you do, you get net assets taken over. They say this is PC. This is PC. That is net asset method. Or they say NATO net assets plus 1 lakh is PC. Net assets plus 1 lakh is PC. Whatever net assets you compute, you need to pay that plus 1 lakh. Like auto driver asks, no, sir, meter mele 10 rupees. Like that, NATO mele 10,000. NATO mele 10,000 is PC. Meter mele 10 rupees is auto. I hope you understood that. So that's how net asset method works. Get this? Very good. And just to hit upon what we already discussed, when you take over these assets at agreed value, what will happen? सोचा है क्या तुमने क्या कभी सोचा है ये क्या सभी सोचा है सोचा नहीं तो सोचो अभी. The question is, under net assets taken over method, transferee company will take over the assets and liabilities of transferor company at agreed value. That is the value other than book value. When you take it over at a value other than book value, what will happen? You can answer. It will lead to failure of condition that we had discussed in the past. Let me show it to you. We had discussed 5 conditions. Here you remember amalgamation in the nature to decide whether it is purchase or merger. We discussed condition. In that, one of the condition that we had is that all the assets and liabilities should be taken over. First condition. Last condition, it should be taken over at book value. So when you do NATO method, if you don't take over all the assets, or even if you take over all the assets and liabilities but not at its book value and change the value to agreed value, it straight away becomes amalgamation in the nature of purchase. Why? You might be failing to fulfill either condition number 1 or condition number 5 as per para 3e of AS 14. If it becomes amalgamation in the nature of purchase, your accounting changes from pooling of interest method to purchase method. Your accounting changes from pooling of interest method to purchase method. Did you guys understand? Great. Quite happy the fact that you remember. If you have not watched part 1, my request to all of you will be, please do go back and then watch part 1 of amalgamation. It is there right before this video. It's a very interesting one and it's going to make you conceptually very strong. Got that, guys? So going back, this is net asset method. So net asset method where PC is computed as agreed value of assets minus agreed value of liabilities taken over. See here. Under this method, consideration to be paid by transferee company, very good, is arrived based on the value of the assets less outside liabilities of transferor, small company, taken over by transferee company. That is under third method, which is net assets method. Then we have the last one, method number 4, computation of purchase consideration. What is fourth method? This is called as intrinsic value method. What is it called as? Intrinsic value method. You can also call this balance sheet approach or balance sheet method. What is this? Now to understand this, you need to go for a little backstory. Whenever you go for merger, one company is liquidating and the shareholders of that company should get shares in the other company. Agree? Whenever the shareholders of transferor company gets the shares of transferee company, how and what proportion do they get? We tell some ratio, no? Shareholders of transferor company, for every 3 shares held in transferor company, they get 2 shares in transferee company. For every 5 shares in transferor company, they get 3 shares in transferee company. They say this ratio. How do you arrive at this ratio? How do you arrive at this 5:3, 2:3, 1:2, or 6:8, whatever ratio? How do you arrive at it? Now, throughout, when we did lump sum payment net asset method, which company's balance sheet are we taking and then taking assets and liabilities and then valuing? Throughout, we are valuing assets and liabilities of transferor company. Transferor company is getting liquidated or it's being taken over. So we value the assets of transferor, we value the liabilities of transferor, we deduct the value of assets of transferor from the value of liabilities of transferor. Then we'll understand the net asset value of the transferor company. Are we giving cash to transferor company? Assume the transferor company's net value comes to 10 lakh. Are we giving 10 lakh cash? We're giving 10 lakh cash, good. If I am giving 10 lakh rupees purchase consideration by way of shares in my transferee company, then my transferee company's share will have some value. Who decided that value? 10 lakh rupees is that company's shares, no? Net asset. I will say my company's share value is 1 lakh per share. I will give only 10 shares. Or I'll say my company's one share is 10 lakh rupees. I give only one share. Now I valued their company's assets and liabilities. Valuation should happen to transferee company's assets and liabilities also. So we'll value the share value of each share of transferee company. Assume that we arrive at 1000 rupees as the value. Then we'll say 1000 rupees is my company's share value. Their company's share value is 500. Each share, we arrived at 10 lakh, no? We'll divide by number of shares. 10 lakh is net asset value, assets at agreed value, that's liabilities at agreed value. If you deduct, you will get net asset value, or in FM you do NATESH, net assets available to equity shareholders. So you take that, you divide by number of equity shares of transferor, you get each share value of transferor. Similarly, you do for transferee. Transferees each asset at market price minus each liability at market price. We get the net asset value per share. So we have per share value of transferee, per share value of transfer. We compare these two to arrive at the exchange ratio. If transferee company's each share is 1000 rupees and transferor company's each share is 500 rupees. So 2 shares of transferor is equal to 1 share of transferee. 2 shares of transferor is equal to 1 share of transferee. 500 per share into 2 shares is 1000. 1 share of transfer is 1000 into 1 is 1000. 500 into 2 is 1000. So for every 2 shares held in transferor company, we give 1 share in transferee company. This is intrinsic value method. There are interesting questions on this also which needs to be learnt in your exam preparation. The time permits, towards the end I'll do one more video in which I'll be discussing one question based on intrinsic value method. There's one nice problem called big and huge limited, big limited, huge limited. So, and there's one A limited, B limited question also. So I'll try and do one of the questions. If you have any other question on amalgamation which you want me to do, let me know in the comments so that I'll solve that question also. If you got that, guys, I've kept myself a target of 5 to 6 parts max, not more than that. That's about totally 4.5 5 hours for entire amalgamation, which you usually learn for 20 hours or 25 hours odd in the regular class. I'm going to finish it up in this much, but give you 100% concept in depth, not like overview also. In-depth conceptual knowledge with problem practice. Not all the problems, but I'll do 1-2 problems, but I'll explain the entire thing in those problems always. Got that, guys? Yeah, that's intrinsic value. In fact, I'll show you some recent happening that is there. Recent happening, HDFC, NBFC, HDFC which is an NBFC and HDFC Bank merged. So there was agreed ratio there given also. Okay, wait, fine, let me show. See, HDFC Bank and HDFC merger ratio. The share exchange ratio of amalgamation of the corporation with and into HDFC Bank will be 42 equity shares of face value ₹1 each for every 25 fully paid up equity shares. So HDFC Corporation and HDFC Bank, my ratio was 42 shares for 25 shares. 42 shares for 25 shares. So 42 is to 25. Computing this ratio itself is a big task, which you can be doing in the future. And you people get to start working on this mergers and acquisition. People usually specialize in tax, people usually specialize in assurance, internal audit, so they specialize on one subject in the future, indirect taxes or something, indirect taxes or direct taxes or transfer pricing. But let me tell you something, just this chapter of amalgamation itself is a wing in lot of big fours and lot of big firms. They have one separate department in the firm called as M&A, mergers and acquisition, which exclusively deals only with amalgamations, mergers and corporate restructuring. So this chapter is not just 15-20 marks in your exam. This chapter can become your career choice also. Maybe post qualification, for the date till the date you retire, you might work only in M&A department. Now in fact, I had a student whom I had taught 2.5 years ago. A student of mine for foundation as well as inter. 2.5 years ago when she cleared her inter, she had texted me asking, sir, I'm joining GT, but the vacancy is there only in M&A part. Can I take it up, like to specialization right in the beginning? Is it a good choice? So I was so surprised. People post qualification think that they don't want to specialize immediately. They want to be master of, or say a jack of all rather than being master of one. But in the modern time, the specialization is growing so big that you're getting to specialize not only in tax or audit, but you're getting to specialize in M&A during your articleship. So 3 years of M&A internship specialization in M&A. If you qualify, and then trust me, you have immense experience, you have such nice career opportunities going forward. You are very clear you want to get into only this wing, but it's not like you're trying a lot of jobs. You have very specific job portfolio to look at. But if you talk about the pay, if you talk about the exposure, if you talk about the expertise, if you talk about the need for that job that you're trained for, it will be immense. Trust me, you'll be doing way nice and amazing quality work if in case you do that. So if anyone has this opportunity to work on M&As during your internship, go for it, boy. Go for it. Yeah, we were discussing intrinsic value method. Let's quickly finish that. Intrinsic value method, as I mentioned, it is with balance sheet. We find the balance sheet value. Under this method, consideration is calculated at intrinsic value of shares of the transferor and transferee to determine the exchange ratio. Get that? So once we compute this, we compare our net assets with PC. PC is what we give as a transferee when we take over the business of transferor. As a transferee, when you take over the business assets and liabilities of transferor, what we give them is purchase consideration. Let me repeat, what we give them is purchase consideration. What we get from them, assets and liabilities, net of it is called NATO. So what we get, NATO. Transferee perspective, what we get, NATO. What we give, PC. They both should be equal. If in case what I'm giving is more than what I'm getting, or what I'm giving is less than what I'm getting, the difference is to be accounted. The difference is to be accounted. That difference will be either profit or loss. Profit here is capital profit, loss here is capital. If in case what I'm paying as purchase consideration is more than what I'm getting in NATO, I'm incurring loss, which is capital loss. This capital loss is called as goodwill. And if in case what I am getting is more and what I am giving is less, my PC is less, NATO is more, it is capital profit to me, that will be transferred to capital. Let me repeat, PC is what I give, net assets is what I get. If I give more PC and get less value of net assets, transferee company is paying more than what it's receiving. Such amount what they paid more beyond NATO is capital loss to transferee, and it should be transferred to goodwill account. The benefit of it will be taken over a longer period, so we'll transfer to goodwill and amortize it over the next few years. You get that, you'll read in AS 26. If in case the PC that I pay is less and the net assets that I'm getting is more, net assets that I'm getting is more than the PC that I give, then I'm making profit. I'm making such profit will be called as capital reserve. Let me show this to you. Difference between purchase consideration and net assets taken over is what we're discussing. So if my purchase consideration is greater than NATO, I'm paying more, that is capital loss, which will be transferred to goodwill account. PC minus NATO is goodwill. In an alternative scenario, if my purchase consideration is less and what I'm getting from net assets of transferor is more, I'm making profit, such profit will be transferred to capital reserve. Get that? That's it. Now next in case we need to discuss journal entries, but before that let me show this to you if anyone wants to take a note of this computation of PC but could not take note because I just scrolled through. I'll show this to you for 10 seconds. You can take a screenshot of this or write this down. I'll give a small pause, maybe of 10-20 seconds. Yes, I hope you did. Next, I'll show you this part. You can take a small screenshot or note this down into your book. Difference between PC and NATO, how to deal with it. Got that? Fantastic, guys. So this is with regard to part 2 of amalgamation. Very soon you will be able to see part 3, in which I'll discuss the accounting entries in the books of transferor accounting entries in the books of transferee, and how to prepare balance sheet after amalgamation in the coming up video. We'll be very eagerly waiting to see you all in that video. I hope you will all join me and watch that video. I hope, and I hope you finish this part 1 and part 2 by then. Done. That's it, guys. Just to keep you people informed, if you're writing exam in November 2022, I'm coming up with a last minute revision marathon for your CA Intermediate November 2022 advanced accounting examination. The entire revision will happen in about 200 minutes. All the chapters. I promise you all the chapters other than accounting standards. Yeah, so you can definitely stay tuned for that. I'll give you more updates on that very soon. That's it. Remember, life is not a battle to be struggling. It's a game to be enjoyed. Till the time you're learning something new or having fun, it's all good. The day you guys either stop learning something new or stop having fun, trust me, you might start struggling because you might be in the battle. So thumb rule to stay happy is pretty simple. It is to stay in the game. For one last time on this day, I have just one simple question for all of you. Are we in the game? I hope the answer is yes, we are in the game. See you all in the next video on amalgamation. Till then, tata, bye bye, take care, and get lost.